Today we're going to talk about price versus net proceeds and why the highest offer isn't necessarily the best offer for a home seller. My name is Sharon McLennan. I'm a real estate broker with over 25 years experience as well as a licensed CPA, and I want to make sure that I help you get the information that you need to make the best possible decisions for your home sale. So let's go ahead and dive on in. A common seller assumption is that if they get the highest price, everything else is going to work itself out. And the truth of the matter is that is not accurate. Price is only one part of a very complicated transaction which involves selling your home. What you have to do, as in all complicated matters, is evaluate the entire situation to make sure that the combination of outcomes works in your best interest. The goal isn't necessarily a high upfront number, although that is important. The goal is to make sure that when we've gone through the process, at the end of the day, taking into consideration all of the costs, you are in the best possible place that you can be as it relates to your home sale. Now, what do I mean by that? What does a seller actually keep? The sales price, obviously, is the gross. That's the offer that comes in from the buyer, and that's what the seller is choosing to take. But there are many other costs that are specific to the transaction that really should be factored in, right? One of the things that a lot of times sellers don't focus on is how sure of a deal is this, because time is really money in this equation. In the real estate world, time is money. And the longer that you keep the property as you're trying to sell it, is the less that you're actually going to end up netting. So if you have a property that you're trying to sell, if you can sell it in 30 days, that is better than selling it in 90 or 120 days, because time is money. The longer you hold it is the more that it costs you. So we want to keep that in mind. So as a seller, what do you actually get to hold on to? You have the sales price, which is, again, the offer that is coming across from the buyer. There are also fees, taxes, and commission. Real estate taxes get prorated. So the longer you own the property is the bigger part of that property tax bill you are going to be responsible for. Once all of the expenses are settled, the net proceeds really is what you are going to walk away from. And a lot of times sellers don't even really take that into consideration. They lock in on the sales price without spending any time thinking about what the repercussions are, what the timelines are, what the uncertainty is as it relates to the offer, and they end up with less net proceeds than they could have if maybe they went with a different offer. So what are some common deal killers? Very important, the strongest offer in the world, we have to make sure that the buyer is ready, willing, and able. And by able, 9 times out of 10, that is going to mean that they're able to secure and close on their financing. Unless it's a cash deal, we need to really spend some time looking at the financing to make sure that this is a solid offer where the person is going to be able to close on the property. A lot of times sellers push to get the highest possible price, but pricing, especially in this market, is very important, because one of the worst things in the world is to hold out for a higher price than the market usually would provide, finally get a buyer who is so in love with the property or who wants it so badly that they're willing to pay the higher price, go into the deal and get an appraisal that does not support the value, and then ultimately have to come back down to the appraised value. So that costs you time, and sometimes if you don't want to reduce, the buyer may walk away either because they don't want to or because of their financing they're not able to pay above appraised value. Now you're putting the property back on the market to start the cycle again. Remember, I said time is money. So the longer we're taking going through multiple buyers, that is going to end up costing you. And while it may not show up on the closing statement that you get when you sit at the table, there are definitely costs that are going to be associated with that. You may accept an offer that's a really strong offer or a high offer, but they want an extended inspection period. The inspection period is 21 days, or they need a 30-day inspection period, during which time they can decide that they're going to walk away if there are defects with the property. You want to make sure that all of that plays a role. How long is the inspection period? How long do they need to get their financing? What could potentially cause a delay? How experienced is the buyer? How experienced is the agent on the other side to make sure that you are getting a strong offer? Remember, the higher price doesn't work if the deal falls apart. So if the deal is going to die 30 to 45 days out and you have to start the process again, that does not work in your best interest. So you want to make sure that you're balancing not only the amount that's offered, but also the strength of the offer. So let's look at two real world examples. We have an offer A for $500,000 and we have an offer B for $525,000. Offer A is obviously $25,000 lower than offer B. But offer A is a conventional loan. They're putting 20% down. They're pre-approved for their financing, so you know that they've gone through the process. They're approved for funding. They are waiving all of their inspections, or they have a very short inspection period, so you'll know fairly quickly that if there are any problems with the property that would prevent them from moving forward, and you have a strong buyer. So offer A could potentially close in 30 days and there's zero concessions. Offer B, on the other hand, is for $525,000, but it's an FHA loan, 3.5% down. And I'm not knocking FHA loans by any means. I do a lot of business with buyers with FHA loans, but this buyer is financing 96.5% of the sales price versus 80%. So it's a riskier loan, if you will. They also have an appraisal contingency. So if the property doesn't appraise, they're looking to get the price reduced. They want to have a full inspection and they need 15 days to do it. And it is likely, given the age of the home and the condition, that they are going to come back with repair requests. We just know that is what's going to happen. If at the end of the day, comparing those two offers, and you went with $525,000 and the offer, the inspection came back, they asked for $15,000 in repairs, and the property appraised at $510,000, that has eaten up the entire $25,000 difference. Because if it appraises at $510,000 and they're looking to pay $510,000, you bring the price down to $510,000, and now they're asking for $15,000 in repairs. Ultimately, you're ending up at a $495,000 net price, because that's the $525,000 less the $15,000 for repairs and less the $15,000 that you had to take as a reduction to get to the appraised value. So now your net number is $495,000. So if you had gone with the $500,000, you would have actually had a $5,000 higher offer. Not to mention when we have issues like an inspection problem or an appraisal issue, that typically adds time to the closing process. We're probably going to have to get an extension, and we won't close within that 30-day window. So you are now going to be holding that property for longer and ultimately ending up netting less. Of course, all of this is easy to say in retrospect. None of us have a crystal ball. None of us know how things are going to work out. But it's really important to take into consideration the strength of the buyer, the strength of the offer, what the contingencies are that the buyer is asking for, how much accommodation they're looking for as you're evaluating multiple offers. Obviously, if you only have the offer B, then that's the offer that you're going to consider. You're going to negotiate that offer. There's nothing else to compare it with. But if you do have two offers, just because one is higher than the other, that does not automatically mean that it is the better offer. And just need you to keep that in mind. Okay, let's talk a little bit about the appraisals. And a lot of times sellers have properties that they've done improvements in, and they know what they paid for those improvements. And so you know that you spent X number of dollars redoing the kitchen, or you have Y number of dollars in upgraded landscaping. But at the end of the day, none of that matters in the appraisal. Yes, the condition of the property absolutely is important, but what the appraiser is going to do is they're going to follow the data. They're going to look at what homes in the area that are similar to yours sold for within the last 90 to 120 days, and they are going to be making adjustments to those properties to your property based on whether your property is better or worse. They use the words superior or inferior to the ones that have already sold. So it's all data. There's no emotion. There's no looking at it and saying, oh, it's beautiful. If the property is upgraded, there's a typical cost or a typical value that gets attributed to an upgrade. So a modern kitchen, the upgrade may be $20,000. It doesn't matter that you spent $40,000 putting it in. If the adjustment for an upgraded kitchen is $20,000, then that is what they're going to attribute to come up with the value for your property. So do keep that in mind. The buyer does not control the value. Okay, the buyer will control their offer. They will offer what they think the property is worth because they want to get it. But when all the dust settles, at the end of the day, the decision in terms of what the value of the property is coming out of the appraisal is going to be made by the appraiser, and it is going to be based on what the comparables in the area have sold for and what is on the market as the competition. That gets factored into the calculation as well. When homes don't appraise, a lot of times the buyer is going to ask for a reduction for a couple of reasons. One, nobody wants to pay more than they think something is worth. But two, most importantly, a lot of times they don't have the extra money because the bank is not going to finance beyond the appraised value, right? If the property does not appraise, the bank is not going to finance the difference between the appraisal and what the seller wants to get as the sales price. So what that means is the buyer will have to come out of pocket to provide that cash to be able to secure that closing. When you take into consideration that they're already out of pocket for a deposit, they're already looking to be out of pocket for closing costs, which can be significant. A lot of times they just don't have the resources to be able to come up with the difference to pay above appraised value. So keep that in mind. It's not that they don't want to do it. A lot of times financially, with everything that is being asked of them, they're just not able to hit that target and to reach that goal. Now, we talked about it a little earlier. Time is money, right? So when you have an appraisal or property that does not appraise and the buyer walks, you are now required to put that property back on the market. You are now going to wait for another buyer who conceivably could have the same constraints. They could have the same problems in terms of they're going to need an appraisal. They're going to need to get financing done. So unless their financial situation is different, where they can come up with the additional cost over the appraised value to secure a closing, you may find yourself in the same situation all over again. But the thing to keep in mind is every month that the property is on the market, you are paying a mortgage, you are incurring costs for property taxes, you are paying utilities, you're incurring costs, they're carrying costs associated to keeping that property. So holding out for an extra $10,000 on a sale when it's costing you $2,500 or $3,000 a month to keep the property, it doesn't take long for that $10,000 to get eroded. If you are paying $3,500 a month to keep a property, including your taxes, you're paying for insurance because it has to be insured while you're owning it. If it's costing you $3,500, at the end of 2 months, that's $7,000. At the end of 3 months or 90 days, that's $10,500. You don't want to hold out for a $10,000 over appraised value adjustment in price, because at the end of the day, when all the dust is settled, what you're going to find is that you've lost that money. It went out of another window as you are waiting for that $10,000 to come through the buyer's door. It went out to the expense window. So again, it just doesn't make any sense to hold out for more than the appraised value in many cases. When the market is the market, you want to make sure that you're clear on that. So the takeaway from all of this is your pricing strategy is very important, right? You want to make sure that you price the property correctly from day one. And I've worked with a lot of sellers over the course of my 25 years who have said, all right, let's put it on the market and see what happens. The challenge with that is your property gets the most attention within the first 5 to 7 days that it's on the market, because it's considered new and people are interested. People who have been waiting, who've not been able to find something, they're all very interested in your property in that first 5 to 7 days. After 5 to 7 days, it kind of merges in with all the other properties that are on the market, and now it's not getting the amount of interest that it got in those first 5 to 7 days. So if you squander those days by overpricing, then what happens is your chances of a timely sale are significantly reduced, because when it's a part of general population, it's not going to get the interest or the visibility that it would have gotten in that first 5 to 7 days that it was on the market. When a property is priced properly, it does a couple of things. One, it creates interest. It also sparks competition. It sounds funny to say it, but the market really knows what the value is on properties. And it's so funny. There have been many cases where we've had properties listed and the seller was adamant that we put it on the market at a higher price than we recommended. So slightly higher, we did it to accommodate the seller. And that property sat there for 3 months, 4 months. And then ultimately, when the market caught up with that value, we got, having had it sit on the market for 3 months with nothing, crickets, all of a sudden in the space of a week, we got 3 offers because the market caught up to that price, and now it represented a reasonable value given what was out there. So it's really important to make sure that if you're trying to get in, and selling a home is stressful, particularly if you're living in there. You don't necessarily want to go through 120 days of being ready to show at a moment's notice and having people coming through your home as you're trying to get it sold, right? So at the end of the day, what we're looking for is a fairly timely sale so that you can go on with the rest of your life without having the sale of your home become the be-all and end-all of your existence. So just keep that in mind. You want to make sure that you price strategically, get competent advice in terms of what is happening in the market, how your property stacks up to what is happening in the market, because even if we price it above market and we are fortunate enough to find a buyer who is just so interested in the property that they're willing to overpay, chances are when the appraisal comes in, it's going to show an adjustment. It's going to show that you're overpriced, and now you're back in a position where you're either going to have to reduce it, the buyer is going to walk away. There may be a slim chance that the buyer can come up with a portion of the difference, but again, this is going to delay your closing, incurring additional costs, incurring disruption to your life. None of it, in my opinion, is particularly desirable, so just keep that in mind. The real question that you want to ask is, what is the most reliable path to the best net result? Remember, it's not the sales price, it's the net proceeds that are our focus. And while net proceeds don't include the carrying cost for the property while you have it on the market, you should have an idea as to what your monthly costs are and factor that into your calculation as you're evaluating your options. I hope that you found this information helpful. As always, if you have a question, please feel free to reach out to me. The best way to contact me is through my website, simplyaskSharon.com. There's a link there where you can schedule a free consultation call with me at your convenience, and I'll be happy to go into greater detail around your personal situation. Thank you so much for watching. I hope this was helpful, and I look forward to seeing you the next time.